TCW Group CEO Katie Koch telling us a few moments ago that it is possible we get another rate hike, maybe in June. Our next guest agrees, saying not only could we get one in June, we may get another one in the second half of the year. Joining us this morning, Oppenheimer Chief Investment Strategist and Managing Director John Stoltzfus. John, it's great to have you back. Talk to me about why you think the market may have this wrong.
Great. Carl, thanks for having us on CNBC. Great to be here with you. We've been thinking the market's been wrong about this a pause or cut business for quite a while. The inflation is simply running too high. While we have the Federal Reserve thus far has taken inflation down, the headline number, from around 9% to a little under 5%. There's a long way to go to that 2% target. And the Fed speak keeps telling us that it's not so much bifurcated, it's just diverse amongst the economists there. The thought is some think that we could pause, that others think that, likely, I heard Bullard once thinks rates go higher from here. And we certainly think so, but we don't think it disrupts the markets.
Really? I was going to say, how would the S&P react to a June hike?
Carl, I've been in this business for just around 40 years. So when I came in 1983, Paul Volcker was still ruling the Fed. And the question still remained amongst clients and amongst professionals in the industry, is inflation coming back? Will the Fed fail? What have you? And yet, if you look at the markets from 1979 through 1990, I mean, you've got a lot of plus years there when rates would vacillate, going from higher to lower. And the market gets used to the fact that you're dealing with higher rates from the Fed, especially in this case. We're just getting over free money. It's the end of free money, which we saw had been achieved by a combination of Fed policy and fiscal stimulus by politicians. It took us to 40-year highs. But it's not. This is not a case where we feel that Powell has to become a Volcker. He just needs to be Powell in these modern times, and we think he'll bring down inflation on a very sensitive level. He's done it so far.
So, John, if you think that there's another rate hike in the cards and the market's got it wrong, does that influence your earnings outlook and your equity market outlook? Because wouldn't that mean that the chances are higher for, as what Katie mentioned, a medium to hard landing, which is not factored in?
Well, we think that actually we think because of the slower growth that will likely come through the system as a result of the regional bank problems that we've seen in that space, where you have a crisis of confidence, that will likely see increased regulation, tighter lending practices from that group and its implications. It will contribute to slowing, which will allow the Fed to remain very sensitive in terms of how it's hiking. And thus far, with 10 hikes in the box thus far, I'm looking at my screen. On a year-to-date, the S&P is up 16.93% from October 12th low. I'm sorry, the S&P 500 year-to-date is up 8.94%, but from the October 12th low, it's up 16.93. Curiously enough, you've got real big gains in technology, of course, and communication services, but also industrials, materials have participated in these rallies, and consumer discretionary. It's quite a story. And what it shows is a progression wherein the better players, the quality stocks, are able to move higher, even as the Fed sensitively adjusts interest rates to rid us of this free money environment that we've been in, which is not good for the markets or for Main Street.